In order to be able to calculate the price per $100 of face value we pay for an investment, Excel provides us with three tools: the functions price, PRICEMAT, and PRICEDISC. In the current worksheet, you can see the details of a security. We have our initial investment, the issue date, which is the date the security was issued, the settlement date is the date after the issue date when the security is traded to the buyer, and the maturity date is the date when the security expires. We can see we have already calculated the prices in cell B13 to B15. We have calculated the price for three scenarios: for a security that pays periodic interest, for a security that pays at maturity, and for a discounted security. We see that at the discounted security we pay less money for each $100 of face value. This doesn't necessarily mean it's the most profitable choice. To determine which scenario is the most profitable, we have to look at the yield values. In this case, it happens that the discounted security is the way to go since it has higher yield. It's time to see how these functions work. In this worksheet, we have a different investment plan. In this plan, we have to calculate the price for each of the different three scenarios. We again have our initial investment, our issue, settlement date, and maturity date, and the other security details we are going to need. The first scenario assumes that the security pays periodic interest. So in cell B13, we type the function price. First attribute is the settlement date, second the maturity date, the annual coupon rate is the third attribute, cell B6, the yield resides in cell B9, the redemption value per $100 of face value is in cell B8 and is the redemption attribute we see here on the function, and the frequency is the number of coupon payments per year. We have one payment per year, so the frequency is 1. The last argument, basis, is optional and it helps us choose the type of day count to use. Since we will always use the default 0 value, we can omit it. Close the parentheses and click on Enter. Our security's price per $100 of face value is approximately $94. Next, we will calculate the price for the scenario that assumes that the security pays at maturity. We type in cell B14 the function, followed by the settlement date, as we're going to see, then by the maturity date, issue stands for the issue date, the rate is the security's annual coupon rate as before, the yield of a security that pays at maturity is now in cell B10, and we omit the last optional attribute and click on Enter. We can see that the security's price per $100 face value for a security that pays at maturity is a bit higher than the one we have previously calculated. Lastly, we will find out what the price per $100 of face value is if the security is a discounted one. we type in cell B15 the function, which is PRICEDISC for discounted price, the settlement date, the maturity date, followed by the discount rate in cell B12, and the redemption value per $100 of face value. Close the parenthesis and we click on Enter. Take note that here we used the discount rate in cell B12 instead of the yield for the discounted security, which is in cell B11.